We'll start with the questions first. Some of the questions you have asked at the time of registration, we'll try to address them.
What should a portfolio strategy for the current financial year comprise of?
Okay, so markets are not into that kind of a shape or structure that we may see a sustained bull run or a cycle which will last us for 1, 2, 3 years. Gone are those days. In fact, nowadays cycles are changing very rapidly. So in a calendar year, you may end up having 2 bull markets and 2 bear markets. So in such a scenario, it is very prudent to think like a trader when it comes to portfolio as well. So our advice would be to have the short to medium term as mindset when it comes to picking portfolio, booking profits in the portfolio as well. And as we are coming off after like 6-7 weeks of underperformance, it is if you happen to invest in some of the recommended portfolios by us, or even if you've handpicked a certain set of stocks, be very nimble-footed in booking profits at regular intervals. Anything Nifty, whether it be Nifty, whether it be any segment of the market, any index of the market, sustained rallies are something which are very, very much absent. And given the kind of backdrop of mixed earnings plus a lot of uncertainty going ahead with the geopolitical thing, although a lot of it is behind us, but it is always advisable to be very, very flexible in your approach. So have a 3-month period for your portfolio. Let's say you invest in August, September, October, November, look to be booking profits as well in the next 3 months when the Nifty does well and markets go up as well. So buy and hold is something which may not essentially work in this kind of a market.
How to identify multi-baggers for the long term?
Yeah, multi-baggers is one area where a lot of hits and misses are there. Plus, it is very exciting but very difficult as well. So just to give you a perspective, out of let's say 10 stocks that you may take, ideally the expectation should be low. Let's say out of 10 stocks, 2 of them turn out to be multi-baggers. The rest out of the let's say 8 stocks remaining, out of those 8, 2 or 3 may be very negative, whereas the rest of the others would be anywhere in the vicinity of Nifty return plus and minus 10% here and there. So the beauty of multi-baggers is in the asset allocation, not in the idea. Yes, ideas are important. Yes, it is important to get into the right stock at the right time, but risk management is even bigger play. So let me give you a perspective. So let's say 2 of your stocks turn out to be 5x or 5 times. They give you a return of 5 times over a period of, let's say, next 12 months. And it's very difficult to do that. But let's say you end up with having those 2 stocks. And let's say the rest of the stocks are anywhere in between 20 to 30% kind of a return. So even after that, your portfolio return will be substantially very good. Now the next question is how to identify them. So from a technical lens, one way to identify multi-baggers is to look out for major reversals, whether it is long-term charts, monthly charts, weekly charts. Whenever there are long-term reversals that happen in a particular stock, I'll give a perspective of what happened with Zomato. The stock got listed. Everybody felt that the stock has listed at a premium, saw some profit booking. There was a prolonged phase of the stock seeing a correction. The stock went as low as I think 40 rupees on the downside, spent some time over there. And once the stock started reversing, it was, we all know the kind of performance that has happened over there. So look out for these macro setups, macro patterns. During the course of this webinar, we will discuss 1 or 2 setups where we think there could be a possibility of a big long-term reversal which is on the cards. We'll discuss that on the chart, and essentially the crux of the matter is you may identify 8 or 10 ideas, but divide your money equally amongst all these pockets so that the risk is diversified, and at the end of the day, even if we get a few lemons, it doesn't impact our portfolio in a big way, and the law of probability eventually catches up if the markets are good.
What are the prerequisites which lead to short covering?
Yeah, that's a good one and very important given the kind of backdrop that we have in the Nifty nowadays. So in fact, today's session, the data would be very interesting to watch. At the end of the day, we've closed about the 25,000 mark. In fact, it's a very interesting close around the 25,050 mark, and 25,000 has been acting as a hurdle. A lot of call writing at that strike price, at 25,000 strike price, and now eventually think that has gone out. So the prerequisite for short covering has to be the opposite of what happens when there is a meltdown. So we've all experienced what meltdowns are. We hold a particular position, and let's say the position goes against us, we keep on holding on to it. Let's say 100 rupees stock becomes 90, we hold on to it. 90 rupees stock becomes 85, still hold on to it. Let's say on the mental level, 80 is something where the maximum pain is, or where the maximum losses as far as our leverage, our position is concerned. So beyond 80 is when the meltdown or the capitulation will start happening in the stock, and we may see a market, or we may see the stock reversing after it has triggered those stop losses. Same way, the thing with short covering is it doesn't necessarily happen in a big way when say a resistance is taken out, but it happens when the average of this entire position, let's say the August series, the average price of shorts that have been done over the last 4 to 5 weeks, let's say last 3 weeks, is let's say 25,200. So 25,200 is my average shorting price. So anything above this will start giving pain to the short seller, and there would be a point where, let's say 25,800, it could be 25,500, where maximum pain will be inflicted for the people who are carrying these shorts. So these are the areas where you could see short covering emerge in a very big way, and market getting a thrust generated upwards because of this short covering. So at this point in time, where is that level? That's a good, interesting question to ask. So as of now, that level that we are envisaging is at 25,500, and anything above 25,500 will trigger a wave of short covering where Nifty can accelerate towards 25,800 as well. So as of now, fingers crossed. This is still a work in progress. The data is still evolving, but given the context and given the positioning of August series, where the series began with an extremely aggressive long short ratio by FIs. They were aggressively short. The series began where markets were extremely oversold. So anything above this 25,500 mark will be a very, very tight short squeeze if they are still in the system by that price. Perfect. So what are the factors that will play the market in the rest of 2025? Now the first thing is the GST rates are a welcome change. There is a lot of catch up to be done in the short term. So over these last 4 to 5 weeks or 6 to 7 weeks, Nifty has been underperforming. Global markets have been doing extremely well. So a lot of catch up needs to be played over there. In terms of geopolitical setup, a lot of negatives are already priced in at the current moment. So any positive development coming from the Ukraine-Russia war, coming from the tariffs, we are almost getting there, where India has stood very firmly against the US tariffs, and there could be a breakthrough anytime soon. So these two reasons, which were primarily the reasons for dragging the markets down, are not impacting us, should not impact us that much. The sharpness of the blade has been blunt, and we feel that markets will be looking forward to what next. So from earnings perspective, so far the numbers have been mixed, frankly. So the numbers haven't really excited the markets in a big way. But yes, rate cuts are something that can excite the markets going ahead. So in the last RBI meet, we saw the governor taking up a pause in the rate hikes, given the kind of backdrop that we had with the US tariffs and things like that. So rate cuts is something that may resume once we have more clarity on the tariffs. And in fact, just to give you a perspective, Japanese markets have gone up by as much as 8% in the last 2 weeks after they had clarity on their tariffs. So once the clarity was there and that firm stance was there, okay, this is the final thing that is happening with the Japanese economy, they rallied in a big. Obviously the earnings were good, the earnings boost was there, which helped the Nikkei index surge higher. But just to give a perspective that it can play a big role. Brent oil remains low, on the lower side, trades lower, which is positive for India, and reforms, if any, over the next 3-4 months would be one area where markets would be closely tracking on. And this, like a lot of big people, intelligent people have said that the time is right for these reforms to come into place, to kickstart the Make in India, take the Make in India theme to the next level, and to help the MSCs, help the small manufacturers in India, do well. reforms is something that the market will be closely watching on. Now, if we take a top-down approach of how US markets are placed, so this is the weekly chart of Dow Jones. As you can see in the graph, it has been enjoying a very good period of up move over the last 3 weeks. We've been doing well, but noteworthy is the fact that there is a rising wedge on the weekly charts of Dow Jones. Wedges, rising ones, are essentially bearish structures, which means they're not bearish immediately, but whenever there is a breakdown that happens from such structures, the corrections can be sharp. So keep an eye on this level, keep an eye on this pattern as such, and especially from a breakdown perspective, the last 3 weeks low, the recent up move that has started, as you can see on the graph, the last 3 candles, the lowest part of the third candle is where the breakdown, or the structure will get negated in a big way. So not negated, broken down in a big way. So keep an eye on this. The momentum is slowing down. As you can see on the RSI, the weekly momentum is continuously slowing down, and that is something that has to be kept in mind. So US markets doing well as of now, but the party, it's difficult to say by when will this party go on, but at least as of now the party is still very much on. So this is the Japanese markets outperforming that I was talking of. So over the last 2-3 weeks, Japanese the Nikkei 225 index has done very, very well, and this is broken out from this multi-week tops that was there, and finally we're seeing good traction happening after the clarity on the tariffs that came. Now Chinese markets are warming up. Last week we saw the highest close for the Chinese market since October last year. So China A50 index has come on its own, and there is more upside to be had in the China A50 index. So this is broadly a view of what is happening globally. Things are not bad. European markets are relatively doing well, no real concerns over there. Now if you look at what is happening at a granular level for the Nifty, or for the Nifty 500, which is the broad market index. Now as you can see in this graph, I'll just try to explain how do we read this. So the first green, the yellow part is the Nifty index, so Nifty daily chart. This is where we are today. And then we have the green, first green, which is the percentage of stocks above the 20-day SMA. So let's say out of 500 stocks, as of now 51% odd, or half of the stocks are above the 20-day SMA, 20-day simple moving average. Now every time this figure goes below, goes into this blue line or blue zone, this is the area where markets generally bottom out, and these are good value picking zones. On the other hand, the second green line is where we are seeing the percentage of stocks above the 50-day SMA. So 50-day SMA is a 50-day moving average. So we were very close to the deep value territory as far as the 50-day SMA is concerned, but we've seen a bounce back happening over the last few days. So at least one of the criteria is met. The 20-day SMA has hit that extremely oversold zone, and now we're seeing a bounce back happening in a meaningful way. Now the third line is where these are the percentage of stocks in the Nifty 500 which are above the 200-day SMA. So here the resistance line, or rather the blue line, is in between. Now every time Nifty breaks out of this, or Nifty trades above this, Nifty does well. So as you can see in the graph, this period in second half of 2020 all the way up to 2022, then we had another period last year, 23, from June, July towards March 24, then we had another brief period. So if this ratio, or if this indicator goes above this crucial demand supply area, that is where we see big traction happening on the market. So every time we dip below it, it's a big problem, and markets correct in a very, very big way. So we did not correct in terms of percentage, but yes, price correction was brutal, and the last 7 weeks were testimony to that. So we've hit an intermediate low, and we are recovering from there. So this is still a work in progress, but at least as far as the 20 SMA percentage is concerned, that is very much back to its mean and doing relatively well. I'll try to zoom into this a bit to give you a relatively better picture. So beg your pardon as the pixels may be a bit not so clear, but as you can see, the 20-day SMA has improved, and that bodes well for the current setup of the market. Now let us look at which are the top 3 sectors that can pack a punch. So as we saw, the Chinese markets are doing well. Chinese markets doing well means metals in India do well, and the metal index at this point in time is on the verge of a breakout. So as you can see, this is the weekly chart of the Nifty metal index, and it has attempted a breakout in today's session, which is the reason why we've been bullish on the metal space in today's session, and we feel this index can head towards the 10,000 area, 10,200 roundabouts. So if the index does well, even the metal stocks can really outperform, and good upside can be had in the metal space. So this is one area to keep a close eye on going into the next few weeks. Metals is something that can remain hot. Now defense is another space which has been the best performing sector for this calendar year. So the recent correction, we believe, is a good buying opportunity in the defense space. So from March is where the bottom of the defense sector was. So from March until June, it was a very strong rally that happened. Now we've seen a retracement happening till the 38.2 retracement of the entire bull run, and now we expect that this is one space that can do well. So we also recommended our clients the ETF of defense, which is a MO defense ETF that can be bought into to participate this upside. So sooner than later, this is expected to reverse, and we expect defense stocks to be back to their previous highs. Just yesterday, in fact, HAL got the order for 62,000 crores worth of aircraft to be manufactured, defense aircraft to be manufactured. I mean, the order book is too strong. So not only from a domestic perspective, but also from an export perspective, overall the defense companies are expected to do well, and we feel that over the next 6 months we should be revisiting those highs in the Nifty defense index at the earliest. Now this is the more interesting part. This is the Midcap 100 index. This is a reverse head and shoulder pattern that has been formed on the very long-term charts of Midcap 100 index. As you can see in this graph, the recent correction happened. The index is back above its 50-day EMA, which is the blue line, and a reattempt will be made to test that ceiling of 59,900, 60,000 approximately, which is where we have the breakout of this current setup. So there is a very high possibility that sooner than later this happens. My estimate is over the next 4 months this should be reattempted. And if you are in for a medium term, let's say a 1 year view, if you hold on the on your portfolio, or whether it is your stocks, this is a good time to sort of get into mid caps and ride it. At least the first target would be 59,900, and once that is taken out, there can be a very big breakout that can happen in the mid cap index. So we saw the dip, and we're now seeing the reversal. This is one space that remains very, very attractive at this point in time. So a lot of you would be potential clients. So what does JM Research bring to the table? So our objective is to bring you impeccable directional views on the market, whether it is Nifty, Bank Nifty, any of the sectoral indices. We are there to help you out. Plus, the trading team that we have at JM is very, very active in identifying advanced breakdown and advanced breakout ideas. We are also very much active on the baskets, the technical baskets. Now these baskets are short-term in nature, so the short-term baskets tend to do very well. Like I shared in the very beginning, the kind of market that we are into, baskets is one approach that you can take for investing into this kind of a market. If you are an index trader, there are state-of-art index trading strategies as well, which can be applied, and with the kind of market that we have, Nifty, Midcap Nifty, there are still around 4 active indices where volumes are very significant, and these strategies can be implemented as and when the opportunity arises in the market. and the overall objective is to bring you a premium equity experience, and to help your journey that much more better, comfortable, and profitable in the long run, and to have a meaningful impact. So I hope today's presentation was helpful to you. Thanks, Raj. Thanks to each one of you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.